So, all right, I'm just gonna start making some quick introductions. So I'm Andrew Rosen, president of Diversified. Today, our topic is understanding the mortgage market. And so that's what we're going to discuss. And in doing so, we brought in one of our prize mortgage experts, Matt Lieberman of Apex Mortgage, who's going to talk about what's happening with inflation, how that affects mortgages and interest rate increases and all that fun jazz, what to expect. And we always keep these to 30 minutes or under. So we'll do that. We will take any questions just through type. So any questions anyone has, just shoot an email or shoot a note in the Zoom meeting here. And besides that, we also will share this after the fact with all of our clients to inform. So, Matt, this is your show, your rodeo. Educate us, would you?
Thank you, Andrew, and thank you to the whole Diversified team for allowing me to be on today and share some knowledge and kind of what's happening in today's mortgage industry and mortgage market. It's definitely a timely topic, as I think a lot of people are. A lot of water cooler talk about this stuff. I've just let you know I'm in right outside of Washington D.C. in Maryland, not too far from the Diversified headquarters, and I've been working with Diversified for quite some time, several years, going on 6-7 years. So great organization, and really happy to be here. So the agenda today, what I wanted to go through is understanding mortgage rates, really indicators that drive rates, short-term rates versus mortgage interest rates, which are two separate things. Very, very timely topic today, as many of you may know that the Fed is ending their two-day meeting where it's expected that they will raise the short-term rate to by 0.5%, by 50 basis points, which I'll get into the impacts in a minute. Go over some financing strategies regarding purchases and how we can sort of ease into some of these higher rates with regards to different strategies to ease the effects of the rates. Talk about some refinances. Believe it or not, even with increased rates, they're still out there, and want to discuss some strategies which we use and why we would look at a refinance today. And then finally, is there another housing bubble? Great topic, hearing a lot of this over the last couple of years. And we'll talk about the differences between 2008 and today, lending standards, and really people's equity position currently versus what it was like back in the last housing bubble in the late 2000s. So to kind of jump into understanding mortgage rates. So like I mentioned a minute ago, it's a big day regarding with the Fed meeting. They're expected to increase the short-term borrowing rate by 0.5%, which is really going to impact short-term debt, like, for example, credit cards, student loan payments, credit card payments. Big one for this industry is home equity lines of credit are directly impacted by this increase. And so with that being said, those debts are impacted, but mortgage rates work different in the sense that they are not tied directly to the federal funds rate, which is increasing. However, what I will say is that the outlook of the Fed's comments and policies will have an effect, but it's not directly correlated. So while we see a trend of increased interest rates, that's going to really affect the long-term rates. So a lot of this increase in rates that's forthcoming has already been priced into today's mortgage rates. So we'll just have to see what happens with their meeting. Again, it's expected that they'll increase by 50 basis points. If they increase it by a different amount, it could have an effect on the markets. But it's pretty, I wouldn't say certain, but relatively certain that they will stick with the 50 basis points, which has already been priced in. Now, what will have a big effect today is the comments after the meeting. So at 2 o'clock, the Fed adjourns. Then 2:30, Chairman Powell will speak to commentary on what their long-term thoughts are. And that the commentary is what really moves the market. So if there is talk of increased inflation, even as a result of the increase in interest rates, that could have an impact on what they talk about. So this is a chart that shows a year-to-date impact of interest rates. So this is based off of bond prices. So as bond prices fall, interest rates go up. Okay, so the key to realize is as the chart shows a lower trend, it really means an increase in rates. So year to date, as you can see, we really haven't had a lot of days this year where we have seen interest rates improve. So where we started early in the year, where interest rates were hovering around 3%, we're now here in in early May, and we're about 2% higher than we were actually almost 2.5% higher now than we were in the beginning of the year, which is the fastest increase in rates since the 80s. So it's a very unique time in the industry, and I want to go into kind of how we got to this point. So this is a chart that's going to chart over the last 2 years. So as you see, this is also this is kind of smack in the beginning of the pandemic here. Rates had already dropped in this chart, so they kind of hovered around pretty flat, went up a little bit in 2020, 2021, and then they came down a little bit, and then as you'll see from the beginning of the year to today, we just kind of fell off a cliff. So that's just kind of where we are in terms of rates, and this is as recent as of yesterday. So back in 2020, the Fed decided to change their monetary policy in reaction to the pandemic. So they really wanted to, of course, lead economic recovery. And with inflation low, they figured they'd cut rates to record lows. And they really wanted to focus, it seemed like the focus was a lot more on employment, right? Because a lot of people, of course, lost their jobs than inflation itself. So I think a lot of the inflation got lost during this time. At the same time that they reduced rates, they were continuing to buy mortgage bonds. So what that did at the same time as dropping rates, it spurred the economy by pumping in trillions of dollars by buying mortgage bonds. So it essentially was a way to keep rates artificially low. So that happened really all through 2020 and really all through 2021. And by the fourth quarter of 21, it was apparent that the Fed had kind of miscalculated the amount of inflation and had to start considering raising rates to fight against it. However, it seems like that was a little too late. Genie was already out of the bottle with regards to inflation, and they couldn't put it back in. It just wasn't. It just got essentially spiraled out of control. In the middle of this, earlier this year, we had a little bit of a pause in the increased rates when the war in Ukraine began. Oftentimes, when there's an event around the world, worldwide event that could affect our economies to the negative, investors will invest in mortgage bonds during those times, which in theory would mean that rates would get better because there's more of a demand for mortgage bonds, which creates rates to go lower. Well, that happened initially, but they realized that, or it was realized that a lot of the impact from the war was inflationary. Oil prices, commodities, it just created an inflationary, it caused inflation, which caused rates to increase even more. So it's been a really interesting time with regards to how the war's impacted us. And the Fed, at the same time, I mentioned a minute ago that the Fed decided to continue to buy bonds at a record pace. However, they've recently discussed over the last few months that they're gonna stop buying bonds and taper and run off their balance sheet, which basically means that there's essentially a big supply of mortgage bonds in the market, which when there's a lot of supply and low demand, it causes rates to rise. So that's kind of where we are today. So as the Fed continues to try to fight inflation the best they can, it seems like it's kind of running a little bit wild, and I don't know. I think it's going to subside, but it's definitely had its impact. I really like this quote: "Mortgage rates are likely to continue to move higher throughout the balance of 2022, although the pace of rate increase is likely to moderate. Much of the increase of rates in early 2022 is an anticipation of what will happen later this year, especially with the Federal Reserve interest rate policy." So this goes to what I was explaining a little bit ago, where mortgage rates are not necessarily tied to the Fed. However, policy, the Federal Reserve policy, will drive rates.
So Matt,
yes,
to this point, where do you and other mortgage experts anticipate mortgage rates to land? And let's suggest that we're talking about 30-year mortgage rates end of this year, or really what's the high end? We're starting to look at, do they buy something now and rush? But because mortgage are going to be back to the 80s at 15%.
Right.
Like what's the anticipation or expectation?
Yeah, I mean, well, it's impossible to know. I personally believe that they're not going to go above the 6% range. We're already headed towards that. We're at 5.5%, but I do think that we will hit a plateau as hopefully inflation is contained to some degree. So while I do think that rates might rise a little bit throughout the year, it's still a really good time to buy. I would say buying sooner than later. I don't see rates going down. So I think buying sooner than later definitely makes sense. And home prices, which we'll get into here shortly, really are continuing to increase. And we're really not seeing a bubble, at least as of right now. So we'll get into that in a minute.
Do you anticipate that you see house purchases come down or prices come down?
I think at some point, if rates continue to increase, there will become an affordability issue. I mean, while demand is so high that it almost seems it's so resilient to these rates, where no matter how much these rates are increasing, the demand just continues to soar. So at some point, something's got to give. So if rates really continue to increase, a lot of people's incomes are going to be eaten up by these high loan payments. So we do have some strategies in which we use to kind of alleviate or help ease the increase in rates, which we'll get into in just a minute.
Okay, awesome, thank you.
Sure. So I really like this particular slide. So as you guys may have heard before through talking to Andrew or your advisor, homeownership is really a hedge against inflation. It's where you want to be. You really, in an inflationary economy, you want to be invested in a hard asset that outperforms inflation. So if you go back all the way back to the 70s, you see here the blue is going to be the inflation rate and the green is going to be home appreciation. So as you see, home appreciation has, in pretty much all cases, except for, of course, 2000s, there was something called the housing crash. So of course we didn't see a lot of appreciation then, but overall, if you look at it, home appreciation is going to almost always outperform the inflation rate. So if you look at 2021, while we know inflation is heating up, look at property appreciation. So you're in a great position to own a home right now, because again, and it's, like I said, a hedge. So you're going to be better off owning a home than another reason why it's important to own a home as opposed to not. So purchasing strategies. So this is what I really like. This chart shows you an impact on your monthly payments, given an increase in rates. So let's just say today rates are 5%. Granted, they're a little bit higher than that today, but let's just say 5%. Your principal and interest payment is going to be $28.99 on a $540,000 mortgage. If rates were to go to that 6% rate, so let's just say they went to 6.25%, you'd be looking at almost about a $400 increase in your monthly payment, just by rates going up 1% or 2.25%. So it's pretty impactful in terms of how interest rates do affect somebody's either ability to purchase or their affordability in general. So because of this, because we've been seeing these increase in rates, we're looking at different strategies to alleviate this. So paying points. So for folks who may not know what points are in a mortgage, essentially it's paying money up front, or essentially prepaying interest up front to buy down your interest rate for the life of the loan. So say, for example, a 5.5% rate is at 0 points. You could potentially buy that rate down to say 5% by paying some money up front. It's typically based off a percentage of the loan amount. So on a $500,000 loan amount, if you wanted to pay, say, 2 points, maybe $10,000 up front, you might be able to save 0.5% or 0.5% in interest, which could, of course, really help you from a cash flow standpoint to afford your payments. Where that's a negative is that if you pay the points now, you're never going to get them back later. So if you decide to sell your house or refinance your house before you kind of break even on paying those points, then in reality, you would have potentially lost. I do believe, historically, at least based historically, that rates will come down, especially if this inflation leads us into any type of recession. In any type of recession, we always do see historically a decrease in interest rates. So if you pay the points now and interest rates go down in the next couple of years and you want to refinance, those points that you paid are essentially gone, and you won't have as much of an opportunity to have that lower rate because you're already paid those points to lower your rate originally. So it might take a little more time for your interest rates to improve to where it makes sense. So it's one of those things where we just take case by case. Adjustable rate mortgages, those are coming back in play. They're coming back in play to some degree, but at the same time, we're seeing short-term rates increasing, which is what those mortgages are based off of. So we're not seeing as big of a spread as we usually do, in the sense that an adjustable rate mortgage is fixed for a certain period of years. So in most cases, we do 7-year, 10-year, or 15-year adjustable rate loans, which basically means your rate is going to be fixed for that long period of time until you could potentially adjust based off of market conditions. So the pros are the fact that you start with a considerably, in most cases, a considerably lower rate. So maybe 1.5% lower on the initial rate, and you're fixed for that certain period of time. So 7, 10, maybe even 15 years. So you have that period of time to sort of figure out what you'd want to do, either refinance it, sell it, or potentially even pay it off before it adjusts. Of course, the negative on an ARM is that the fact that once your loan does adjust past that period, or once you do hit that adjustment period, your rate will adjust based off of market conditions. So if you are in a position where you're not able to pay off that ARM, refinance it, or sell, then you could be stuck to some degree, where you could be stuck paying a higher rate over that period of time. And most adjustables do adjust every year after their initial rate adjustment. And so, as you see, of course, on that we just went over, the impact of interest rates on purchasing power, like we mentioned, it could be $500-$600 on a $550,000 loan just by rates increasing by 1%. So definitely has a big impact. So refinancing strategy. So when would you, because in a rising rate environment where most folks have taken care of improving their rate, called a rate and term refinance, where you're not really taking any cash out, we're seeing a lot of people taking advantage of debt consolidation. So while rates, of course, are quote unquote high right now in the fives, that's a heck of a lot lower than rates on a credit card or other debts. And with home equity lines increasing as a result of the short-term rates increases, I think we're going to see a lot more consolidation. But we really want to look at, when we look at debt consolidation, we look at the blended rate. So we look at the blended rate of all of your debts that we're paying off compared to what it would be on a mortgage. And we have different calculators that can really show how it makes a lot more sense bundling up in a mortgage as opposed to paying a blended rate of something in the teens.
Yeah, we do this with you a decent amount, Matt. I know.
Yes,
it's something that we
have some great software that we use to show when this makes sense.
Right. I would also think that with the increase in house pricing, your values, that this has been, we've been seeing a lot more because even
for sure, we're seeing with the property appreciation, we're seeing record amounts of equity. So appreciation and with people having fully amortized loans, whereas back in 2005, 2008, in between those years, a lot of people got interest-only loans. So you're getting people paying down their loans and you're seeing house appreciation. So it's really record amount of equity where people are taking out that money for consolidation or other reasons, buying other property, whatever it might be, and still having quite a bit of equity in their homes even after the fact. So, so definitely something that we're seeing a fair number of inquiries about. So is another housing bubble coming? The clickbait is alarming. We're seeing this all the time. Are we having a crash? Is on its way? Are we in a boom, now a bubble? Home building, crash. I love this one, right? So 2001 was super hot, 2022, not so much. Well, that's not really true. So I really, really, really like this chart here. So this talks about inventory. Well, it really talks about the bubble in general, but the first chart here talks about the amount of homes that are on the market compared to then in 2007 to 2010 as compared to the last 4 years. So as you see, there are, it's pretty crazy in terms of month supply. There were back in the 2000 the housing bubble, there was between 7 and 9 months of supply. So we were oversupplied of homes on the market. In the last 4 years, the amount of months on the market is super, super low. So we're seeing an incredible demand with regards to compared to supply. Lending standards, this is huge. This chart goes over historic data for mortgage credit availability. So back in 2005, with loans that were available to, so I'd say almost anybody, we were seeing incredible amounts of lending availability. Almost anybody could get a loan. After the housing bubble, back in 2009, 2010, when we started seeing recovery, our standards really, really increased. So as a result, there really aren't a lot of quote unquote bad loans out there. Loans that are adjustable for people that don't understand them, or loans that are on fixed rates. Everyone's had their loans documented, their income documented, assets. We're in a really good position. So I really think that as a result, you're going to have people that have predictable payments. Their payments aren't going to rise. They're not going to be in any type of surprise. They'll be able to afford it moving forward. Loans in the billions with a credit score under 620. So a 620 credit score is kind of a threshold that is used in the industry to be considered sort of a threshold of troubled credit, essentially. So if you're over 620, your scores are fine. Under 620, again, it's just a number that's arbitrarily used. You have some credit issues. So back in 03 to 07, you saw 3 to 400 billion loans with credit scores under 620, and then over the last several years, due to lending standards, we're seeing people that are paying loans back predictably. So, and then this kind of goes in line with this. The average FICO score or credit score for by loan types over the last year, the average credit score seems to be in the mid sevens. So we're seeing a much better portfolio of loans out there that are performing. So I really, like I said, I really don't see us hitting a bubble. And lastly, just takeaways from this, I really don't think there's an indication that we're in a housing bubble. Lending standards are under control. Inventories of homes are still way lower than the demand. And that's really the big piece of why we're seeing all these multiple offers in the housing market, is because there's just not enough inventory out there. Borrowers have a stronger financial profile, making their payments, and we've got a lot of equity with a combination of appreciation and folks paying their principal down on their loans. So I think we're in a really good position, even if things do flatten out some. So
awesome.
I will leave it up to any Q&A here for the last few minutes. Anything I can answer for anybody?
I think it doesn't sound like there's immediate questions, but what we'll do is we're going to share this as I started. And as everyone knows, Matt is very accessible and has been a great resource to us at Diversified. So I think we can certainly lean on him as you have questions. He's got some good technology that can help you sift through what makes sense for you, refinance not, costs, assumptions. And I want to thank you, Matt, for your time and expertise as always. And if you can help us keep interest rates low, would you?
Absolutely. I'll do my best.
All right. Thank you so much, Matt.
All right, guys. Thanks so much.